Ladies and gentlemen, welcome to our Q3 advisory board call. My name is Valek and I'm partner at Incrementum. I hope everybody had a great summer and was able to relax and recover from what has turned out to be quite an eventful year so far. We at Incrementum are already in the midst of the busy season again. My dear partner Ronny Stöfferle is currently at a business trip in the US and is attending one of the biggest gold and mining conferences. Hi Ronny, pity that you can't join today, but we're gonna talk, the three of us, two very special guests, which I'm going to introduce in a second. This advisory board call is going to be a little bit different because usually we talk mainly about macro events, macro topics. But as we are managing two strategies with Bitcoin exposure, and as we are currently approaching a very interesting part in the halving cycle, we want to take this opportunity and talk about Bitcoin. The topic of today is institutional adoption, nation-state adoption, and the grand part of the halving cycle. And we are most honored to have two very special guests who are highly qualified to talk about these very topics. I'm honored to introduce independent Bitcoin analyst PlanB and Director of Research from Fidelity Digital Assets, Kuiper. It is my great pleasure to introduce PlanB, a distinguished Bitcoin analyst and the creator of the renowned stock-to-flow model. PlanB, who has a background as an institutional investor, brings a deep understanding of financial markets and investment strategies to his work. PlanB published his stock-to-flow model in March 2019 when the Bitcoin price was below $4,000. Since then, his model has gained significant attention and credibility within the Bitcoin community. In addition to following him on X, we highly recommend his monthly updates on Bitcoin on his YouTube channel, where he discusses trends and developments across various indicators related to the Bitcoin price. We are very excited to have him as special guest today. PlanB, welcome to our advisory board. It's furthermore my pleasure to introduce Kuiper, Director of Research at Fidelity Digital Assets. Chris brings extensive experience in financial analysis and valuation to his role. Prior to joining Fidelity Digital Assets, he served as Vice President of Equity Research at CFRA. His career also includes roles as an analyst for a large cap value fund, a fundamental analyst at Calamos Investments, and a credit analyst at TCF Bank. In addition to his industry experience, Chris was a research fellow at Mercatus Center at George Mason University and is a CFA charter holder. Chris, we are thrilled to have you with us today. So, two high caliber guests and very knowledgeable about Bitcoin. I think we have a lot to talk about, especially when it comes to this halving cycle, where we, in our view, are at quite an interesting point right now. And I would like to start a little bit talking about this halving cycle when it comes to stock to flow. PlanB, as I said, you're very well known for your model. I think it would be interesting if you want to just lay out the basic premises of your models, and then we perhaps can dive into that.
Sure. Well, yeah, like you said, before going 100% into Bitcoin, I was an investor, an institutional investor too, for 25 years. And as an institutional investor, I saw a lot of technical analysis in the Bitcoin space, but not much fundamental analysis. And especially a valuation model was missing. And yeah, so that is, of course, very difficult because an asset like Bitcoin has no cash flow. So it's difficult to evaluate it with discounted cash flow models. A bit like gold, actually. So you could go to production cost-based valuation. And, well, clearly Bitcoin price increased over time. So that could be adoption, right? Maybe an adoption-based valuation model, S-curve, for example. But then again, what drives that adoption? So for me, that was the most fundamental question at the time as an institutional investor. What's driving the price? And so my article in 2019 was an attempt to make a valuation model, and the hypothesis was that scarcity drives Bitcoin's value. Scarcity was what drove me to Bitcoin, and the fact that Bitcoin could not be printed, that central banks couldn't make more of it, that it's not like shares that you can have more shares and dilute the value. Bitcoin is really scarce from that point of view. So in this article, I use stock to flow as a measure to measure scarcity, and that's because I knew stock to flow from commodities, from gold especially. And stock to flow is not very intuitive, by the way, because stock of a commodity, for example, a gold is the above ground reserves, and the flow is the annual production. If you divide that, you get the stock to flow ratio. But if you do that for gold, you get a stock to flow ratio of 60, which is really scarce. Like Bitcoin. Bitcoin is scarcer at the moment, but 60 is really, really scarce. But if you do it for platinum or palladium, you'll get a stock to flow ratio of around 1, which is not scarce at all. But that's very, well, unintuitive to say that platinum and palladium are not scarce from a stock to flow point of view. But anyway, I use that stock to flow as an input in a very simple, linear, univariate regression model. It's very rough. It predicted 55K Bitcoin at the time when, as you said, Bitcoin was below 4K. And, well, yeah, that was a very nice correlation. It's the correlation that's shown in the graph that you show. And, well, a lot of people dismissed it right away because 55K sounded absurd at the time. But some other people loved it, and especially its fundamental nature. And, well, a lot of discussion happened since. And it somehow gained me 2 million followers on X, which is still a miracle to me. But it's, yeah, I love the debate, and it's certainly not the end of the valuation debate.
Yeah, well, thanks for that. I mean, I think one of the main, perhaps, misunderstandings which comes with the model is that it really has a very, very broad, it gives a very broad leeway when it comes to these predictions, right? So due to, I guess, due to the fact of the high volatility and due to the fact that the model is based on a logarithmic scale, the predictions, you have predictions for the halving cycle with a lot of, with a big bandwidth, and perhaps we can have a look at the results where you actually recently tweeted. I think that's the initial model, right? What the predictions were and how actually real live results came in. Perhaps you want to lead us through these results so far.
Yes, that's correct. There's a lot of misunderstanding about the model. Apart from very real discussions and critique that is very valuable, there's indeed this misunderstanding, and the wide predictions bands, the very rough estimates are one of those misunderstandings. Yeah, one thing I want to point out beforehand is that Bitcoin has an implied volatility or realized volatility, historic volatility of around 80%, which is very, very high. It's probably one of the most volatile assets on Earth. So any model that tries to predict the price or value this asset must be very rough. And the price will vary very much from any kind of point prediction. So yeah, with that being said, this model was made 5 years ago. And since then, we have 5 years of new data. And that, yeah, seemed appropriate to refit it to see either, if the prediction was okay, still within the bands, and if the formula would change. So first thing is and it's shown in the yellow line there, I refitted the model with 5 years of new data. So that's 60 months. And what we can see is that the average value over the last halving period of Bitcoin was $34,000. And that's below the $55,000 that the model estimated, but still very close from a modeling point of view. And especially if you keep in mind that the model was made and the prediction was made in 2019 when Bitcoin was below 4,000. 34,000 is still very much in line of this estimate. And the refitted model, and it's shown in the graph, the upper right chart, that straight line, the value and the formula, they haven't changed a lot. The parameters are still the same. The results are still the same. It predicts now 50K instead of 55K. It predicts 500K for the current halving cycle, and 4 million for the cycle after 2028 halving. But I think that's one of the misunderstandings, the wide prediction bands. On the other hand, there's also the fact that it's an average value. And in this model, I did a little bit different than the first model. I predicted the average value, and I inputted the average value of each halving cycle. So there's one thing you could say, and it is that we only have 5 data points in this model, which is not much from a statistical point of view. So it could still be spurious, and that would be a right discussion to have. But if the result or in the next halving period is anywhere near the result that we got last time, so for example, if the price is not 500K that the model predicts, but 300K, I would be more than happy.
PlanB, I had a comment and a question on this, on the variance and the bands. The first comment is just that when I started following your work, shortly after, I forget what time frame this was, but the Bitcoin price was tracking your model to the month-end close. It was just scary and uncanny. And I don't think there's anything in your model that says it has to do that. It just happened to do that. And I think you gained a lot of followers and renown for this. But all of these people then expected that to continue. And so you're a little bit of a victim of your own success, if you will. So they all got the wrong impression that this model was just going to tick like clockwork every single month, giving you the exact price, which it was doing there for many consecutive months. I remember that time. So that was the first comment. The question, though, is on this part that you alluded to of what the bands are, the variance, and whether or not it's spurious. So at what level or point or how long would the price of Bitcoin have to stay out of these bands for you to say, yes, this model no longer works for whatever reason? We're in a different regime, or it was spurious, or can you give us some clue as to what you looked for to say this is no longer working?
Sure. First about the comment, that's really funny because that's one of the big misunderstandings. That was not even the stock to flow model that I used in 2021 for the month-end predictions. That was just for fun, quote unquote, a floor model, which also happens to start with or has an F in the name, floor, stock to flow. So it was kind of unlucky, but the floor model, in fact, was a 10. Was it 10 year? No, it was 4 year. Moving average, but not arithmetic, but geometric moving average. And then it was derived on top of that. So, and like you said, the fact that I got 3 or 4 months, I forgot, but 3 or 4 months spot on correct price, that was more luck than anything else. And it had nothing to do with the stock to flow model, but that got somehow lost in the conversation by some. And I wish I never had introduced the floor model, although it gained me 400,000 followers each month. It's crazy. It's really crazy. Regarding your question, the prediction bands are roughly, so one standard deviation is roughly 2x the model value, and divided by 2 the model value. So for this halving cycle, it would be the point prediction is 500k, and one standard deviation band is 250k to 1 million. And the 2 standard deviation band would be 3x and divided by 3. So those are the bands. Yeah. So, and that's for the average about the period. So if we look back in 2028 and the average is, let's say, below 250k, that's out of the 1 standard deviation band, but in the 2 standard deviation band. But that would be kind of, yeah. It could be it would be still okay from a 2 standard deviation point of view, but I would be a bit surprised by that. But then again, there's so few data points still there. It's hard to say. And of course, those are very rough numbers. We could do the regression analysis again and see if it still fits. If the R squared is hurting a lot with the new data point, and if it really fits, still fits the model.
Okay, great. Perhaps if I can just ask Chris at this point, at Fidelity, so talking about valuation, very difficult task to evaluate Bitcoin, I guess. Do you have different models? Do you look at PlanB's model? Obviously you do, because you know it very well, it seems. What is the array of valuation techniques you look at over there at Fidelity?
Yeah, so we've looked at a few. Some we've published and talked about, some we've just looked at internally. I think the easiest back of the envelope thing is to go back to the investment thesis of Bitcoin as a store of value, an aspiring money, and potentially if that ascends as a store of value and money, people could use it as a medium of exchange. So you start doing just simple total addressable market analysis. What percent of X market could Bitcoin capture? And of course, gold, as you know, Mark, is the foremost one to capture first, in our opinion, as it's the most similar and can play a similar role in the portfolio, but we can talk more about that. Be curious to hear your thoughts as well. So, we're only a fraction of gold's market now, but then you start looking at other asset classes that have a monetary premium embedded in them. Real estate, people aren't just buying real estate to live in, they buy it as an investment, as an asset to hold, and they expect to appreciate, especially in certain tier 1 cities or on the water or what have you. You have even things like collectibles and art and even equities to some extent. A passive investor isn't looking at all the discounted cash flows of the equities they buy, they just view it as a savings vehicle, and they put their money in every single paycheck or month or whatever it is. So that's one way to do it, and everyone can run those numbers themselves, whatever they think is comfortable. You obviously get very wide bands, but it's a start. The other thing we looked at is obviously the stock to flow model, so looking at from the supply side. I know, as I alluded to, it's some people have disregarded it or it's come out of favor as it's moved within these bands. They think it's broken. Personally, I still think it's very helpful to look at. It's a model that still should be looked at on a regular basis as another data point. We include it in our quarterly signals report. So we publish a report that has all kinds of on-chain data on Bitcoin and Ethereum, and we include the stock to flow model there. It's not verbatim PlanB's model because we get it from one of our data providers, Glassnode. So I'm sure PlanB could talk about some of the differences there. He's got the original. But that's one thing to look at as well. And then the other thing we've looked at and published on is the demand side. So we published a piece called Valuing Bitcoin. And so here you look at who's demanding it and how could you value it based on demand. And so one thing you notice is if you chart a regression of addresses, number of Bitcoin addresses to the price, it matches up pretty well. So as the number of addresses go up, the price has gone up. Of course, there's correlation versus causation questions there, but it's a rough proxy. And so then you say, well, if addresses could be a very rough proxy of users, and of course it's not perfect because one person can have multiple addresses, or one address could be the address for thousands or millions of people at an exchange, but it's what we have. If you think of that as one way to look at users, then you could start to map that onto other technologies that have been adopted. So we looked at the adoption of cell phones and the adoption of the internet. And Bitcoin has kind of moved between those. And you get very different bands based on that as well, but it is one way to project or look out at what the price could be, again, just based on these models. And of course, past is no indication of the future, but it's something to hang your hat on. And I'd actually be curious to hear from PlanB. This is one thing we've wrestled with, or at least I'm wrestling with, is people look at the price of Bitcoin and they see diminishing returns. And obviously, Bitcoin had the most fantastic performance when it went from a couple cents to $1 and $1 to $10 and so on. So of course, you're going to have really fantastic performance in those early years. But then lately, with each halving cycle, you get a longer cycle and you get a lower return, a lower upside with each cycle. So people conclude that that is the trend now going forward. But then I look at something like the demand side model and I say, we don't know exactly where it is, but I'm pretty confident that less than 10% of the world has truly adopted Bitcoin. So if you're going to map it on things like cell phones that are 90+% world penetration, or the internet, how is it possible that we're going to have diminishing returns when less than 10% of the population still owns this? And so if people are just listening and they're not looking at the video, I'm talking with my hands here. If you look at those S-curves of technology, there's an initial rise and it kind of levels off. And then when the mass market, the general consumer adopts it, that middle piece, that's when the slope gets really, really high. Again, we're talking about adoption. So looking at like 20% adoption to 80%, most people have adopted it. There's a really steep slope there, especially for technologies like this, where you don't have to have a lot of capital infrastructure like electricity, adoption of electricity or something like that. So to me, it doesn't make sense that the returns for Bitcoin have to keep diminishing if we haven't gotten to that middle part of the S-curve. But PlanB, you alluded to this in one of your videos, so I'd be curious to hear your thoughts on that as well.
Yeah, I think very much like you. In fact, exactly like you. And so I think that's one of the big questions for this halving cycle and the years to come. Will there be diminishing returns or not? Because that would invalidate a lot of models and validate a whole set of other models. And that's the big question that every investor should answer for himself. I do not believe in diminishing returns. And I've been very clear about it. I do not believe in diminishing returns for the exact reason you're talking about. That the S-curve, if you look at the S-curve, we don't know where we are exactly. If we're at 1%, 2%, 10%, I don't think we're even at 10%. But if you look at the S-curve, that's the percentage of adoption, the S. And it could also be the value if you apply Metcalfe's law. But if you look at that S-curve on a log scale, a logarithmic scale, you'll see that the growth of adoption or value is exponential until about 50% adoption, and then it levels off. And so it must follow that if Bitcoin follows the S-curve, like computers, like the internet, like etc., telephones, like you say, like any other technology, if Bitcoin follows that S-curve, its value must grow exponential and not so no diminishing returns until about 50% of adoption. And I really believe that. I also believe that I can understand why people see the diminishing returns. Of course, if you look at the data, you see it. Especially the last cycle was very off. But I think it's an outlier. Actually, if you look at no matter what model you take, the addresses, models based on number of addresses, model based on stock to flow, model based on time, it doesn't matter. You'll see three big outlier years. That's 2013, 2017, and 2022. So the big all-time highs of 2013 and 2017, of course, but also 2022. And that was too low. And so that, in my view, causes the data to look diminishing, where in fact we'll see exponential growth. But I'm not sure, and it will be. That's very interesting to see next couple of years.
Great discussion. Thanks, gentlemen. Perhaps just to describe these, for now at least, diminishing returns, which we saw during the first three cycles. We have got this page on for a few minutes now already. So we saw the first halving cycle, from the full halving cycle from 2012 onwards, with the highest returns. The second one, which is from 2016, beginning in dark blue, with the medium returns basically, and the last one had over the cycle at least the lowest returns, right? So this is what we are talking about when we talking about diminishing returns. And I guess we would actually need to see accelerating returns again to still validate stock to flow model, right? I think one actually also can basically, since the halving cycle, I don't know how long has it been going, more than half a year now, I guess, or roughly half a year. If we need to be over 250,000 on the average price, we haven't been there, right? We have been significantly lower. We obviously need significantly higher prices, at least for some times during the next 3.5 years. Correct, PlanB? So
yes.
So basically, this S-curve thesis, if that plays out, one probably can still validate the model, or it will still stay valid, which I think we all would hope for. But perhaps before we go too much into that part, I think regardless of if one thinks returns may be diminishing or even accelerating, but from the perspective of a conservative investor, I'm even okay if returns diminish, if they keep positive, right? So even if one says one wants to take the conservative stance, then one would basically be okay with the diminishing too. But what I think what is now interesting, and now back to this graph, is where are we at the halving cycle currently? And this is basically what we saw the last three cycles. We saw most of the returns in the first 2 years after the halving, specifically actually more to the latter part of these first 2 years. And perhaps you want to talk about this too, PlanB, because this is basically an application of this revelation, correct?
Yes, and it claws back to the discussion we had about wide prediction bands and about diminishing returns. Maybe we could go back a little bit to the chart before this one, because I love that chart. It shows so many things. It shows that indeed the most of the rise is just after the halving, and then it sort of flattens out. It's stable for 3 more years. And that happened 4 times now. So that, yeah, I don't know if that's a pattern or random, but 4 times it's quite a structure. And then it shows the diminishing returns. So the diminishing returns guys would expect that green line to be below the brown line, somewhere between 100 and 200,000, maybe crashing below 100,000 even in the bear market. And if we just track this line, we'll know what there is. And the third thing you can see is that this wide prediction band between it is shown in this graph. It's the upper line, the yellow line, and the lower line, the brown line. That's about as wide as the prediction band can be. So you can almost see the 250K, 1 million prediction band of stock to flow that I just mentioned. So that will be very interesting. Going to that other chart after this. So basically, here I try to dumb down stock to flow to its core, because there were so many misunderstandings, because it was too difficult for some, too much models, too much statistics, too much mathematics, and it was pigeonholed by others into deep econometric discussions about autocorrelation and co-integration, which is nice, but it distracts from the core. And the core, in my point of view, or my hypothesis, I should say, is that the halving increases scarcity, and that scarcity is valued by investors either directly or indirectly. So they invest directly in Bitcoin because it's scarce, or they indirectly feel that scarcity because there's no supply and there's no market. You can't get them. And so the core is the halving. And if you thus make a very simple stock to flow trading rule that says buy Bitcoin 6 months before the halving, and the halving is every 210,000 blocks. That's what you see on the x-axis there. So every 210,000 blocks, there's a halving. That's every 4 years. If you buy Bitcoin every 6 months before the halving and then sell it 18 months after the halving, the 2 years around the halving, you would outperform buy and hold Bitcoin. And buy and hold Bitcoin is that blue line. That's just the Bitcoin price. If you apply this rule, you get the green line. So you'll end up significantly higher than the buy and hold. And even more important, if you do the inverse, if you would buy Bitcoin 18 months after the halving and sell it 6 months before the halving, so you would hold it only the 2 years in between halvings, you would end up with the red line. You would decrease your value over time. And that, I think, is not random. It could be random. Again, it's only 4 halvings that we had, so it could be a spurious pattern. But I think that scarcity is so fundamental to Bitcoin that we'll see it again. And that's why I made this simple trading rule, not as financial advice, of course, just for informational purpose, to show that scarcity, halving, and value correlation.
Yeah, and I think this is really great because it makes it more applicable and practical, even though it is not financial advice, but one can really derive some applicable value from that. And perhaps what I wanted to point out still is, you write in the tweet 14 months to go, but I just wanted to highlight that. So we haven't seen the most part of the current grand part of the halving cycle because 14 months it is to go still, right? So that would bring it to, if I'm not incorrect, that would basically include the whole year 2025, right? So that's December 2025 this period ends. Is this correct?
In fact, it's 6 months before the halving. That's October close until October close 25.
October, okay.
Yeah.
So we have now the last 12 plus months of this period, and and correct me if I'm wrong here too, I think that was actually within this within these 2-year periods or 24 months periods, even the better time, right? So the second part of this 2-year period.
Absolutely. This is where the fireworks should start or has started historically.
Right. So this is, I think, really the core of what we wanted to talk and what we wanted to point out here. Thanks for laying it out so eloquently. This is great, and obviously very interesting. Perhaps a very few words still regarding this current halving cycle. What we do see here, which is in light green, we are below basically the lowest previous cycle, and I think one can make a very good argument why that is. Why that could be without invalidating this cycle or this pattern rather. I think we saw very high performances 2023, basically pre-ETF. Probably was one of the main fundamental reasons, I would say, at least. By the way, kudos to Chris. I heard you talking in a few days before the halving, warning in the short term that perhaps the halving directly may be overblown in the prices. I think you were really pointed that out pretty well. It turned out to be that this way so far since the halving. Actually, we've been trading water. So if this pattern holds on, we could really see a double firework kind of. That's at least my explanation for this underperformance. I don't know if you see this differently.
Yeah, I would just add on more of the fundamental or color commentary. And of course, it's such a short period, so I think it is applicable to look at what's been going on, but you don't want to look back and attribute too many news stories, of course. But I do think, number one, you pointed out we came off a strong performance, up 155% in 2023. And then we had the anticipation of the ETFs, which were the most successful in all of history of any ETFs by many metrics. And of course, that, I think, pulled a lot of that demand forward. And we hit an all-time high before the halving, which has never happened before. So that was a little bit of a new wrinkle here. And then why this has been the worst one since then, you've had a number of supply overhangs, as a lot of people refer to them. So you had a government up by your way, dumped 50,000 coins onto the market in short order. We had some exchanges that have gone bust that have now started to repay their creditors. And of course, some of those people have either chosen to take cash or liquidate those coins. And so you see these supply overhangs getting eaten through, and that's a good thing that we're finally getting past it. And it surprises me that people continue to make a big noise about it, because it's something that's been known for a long time. But I guess in the short term, some people do try to maybe trade around that a little more. So that's what we've seen so far. But I would agree. You look at on-chain metrics, and it looks like we're right in the middle of a bull market. But the middle is not the middle in terms of the price dispersions or actions. As PlanB and you noted, historically, they've always come in the second half, and that's when things get really crazy.
Yeah, thanks. I think that's a great way to segue to the fundamental view, perhaps. So we have got the setup for potentially very bullish 12 to 14 months from the pattern. But so what is the fundamental view? We've got ETFs now. And Chris, I'm sure you're very capable of talking about how do institutional investors view the asset class, because in my view, at least, institutional adoption would have to be one part of the puzzle that really brings in the new demand to actually materialize this kind of a bull market, which we've been talking about now.
Agreed. There's a large amount of money, of course, that has to come in to take it to the next level. This was one of the very few and interesting asset classes where the retail or the individuals got in ahead of Wall Street. But now, of course, you have Wall Street looking at this. And we do an institutional survey every year. We've done it for 5 consecutive years now. And so this one was fielded in 2023 before the exchange traded funds were approved. So keep that in mind. But here's the top 6 reasons that people responded of what appeals to digital assets. So this is a little bit of a broader bucket than just Bitcoin, but it obviously applies. And number 1, I think it's been number 1 every year, is the high upside potential. And I think that's important to note that institutional investors are just like individual investors. They're looking for the return, right? And that's obviously Bitcoin and other assets' greatest marketing technique, the price action. And I think it will continue to draw their attention. And it's getting to the point where, in my opinion, they can no longer ignore it. And they're going to start to get questions as to why they don't have this in their portfolio, and whether they're fulfilling their fiduciary duty, quite frankly, if they continue to ignore it. And to be clear, some institutions, it may not be right for them, and that's fine, but they at least have to have an answer. And I think that's what we're seeing today.
Right. So why don't they have it so far? I mean, this is already the next slide.
So this one's really interesting to me because now that we have 5 years and we've asked this question every year, you notice some of the responses change over time. And my personal hunch is that institutional investors who don't want to invest for whatever reason, they want to just, it's too small, they don't want to spend time on it, or they're personally against it, they'll just choose the excuse du jour, the most popular excuse going on. And so back in the day, it's used for illicit activities and money laundering, and those misconceptions have finally been starting to be put to rest. And so you see that one drop down a little bit. These are a little more long enduring. And then number 1, it has been number 1 for all 5 years in a row, price volatility. And this one, I've got a personal pet peeve with, I'll admit, because if you're an institutional investor, you should know that volatility is not a reason to not invest in something. And in fact, as you know, Mark, and PlanB in this space, it is your job to manage that volatility. And in fact, I would argue if something is volatile, you probably have, as an institutional money manager, an opportunity to take advantage of that volatility, because usually institutional investors like endowments, foundations have very long time horizons. And so I don't know if this is just a popular excuse to kind of wave it away and not have to deal with it, or if they truly believe it. But again, it gets under my skin a little bit in that, number 1, they should welcome it. And then number 2, and you've seen some of these slides as well, they're working on bad information. It's not as volatile as they think, especially most recently.
Right. I mean, I know exactly what you're talking about, and it is also our experience. We've been talking to institutional investors also for over 5 years now. And this comes up so often, but I think, I mean, in theory, this is a non-argument, just as you said, because position sizing is the solution to high volatility, right? I mean, this is the basic, the basic job of a portfolio manager, to manage the portfolio. You're a risk manager, basically, right? So you want to manage your portfolio and put in size the positions correctly so that you can stomach the volatility. So this is, for everybody who knows portfolio theory, this is no argument, yeah. But I think there is in practice, it still is oftentimes an argument, because if you downsize the position to a very small position, and it's still, I think one has to admit, a very emotional asset, right? So if you're talking to a big institution, you're talking to a lot of people who take the decision, and if you have a few guys or girls sitting in there, the chances are that some of them will veto that, and they won't think it's worth to take personal risk for a small position. So I think indirectly it is probably in combination, high volatility in combination still with an exotic asset class. It is probably the reason why institutions are hesitant, at least that's our experience. But what I also have to note is, I think the ETF decision was a big wake-up call, because I think the legal risk, which was also I think up there very high, has come down dramatically, right? So regulation and legal list, it's not so much the investability, perhaps also for some, but I think institutions have now realized this thing is not going to go away, and they are talking about it. This is our experiences. I don't know if you see this differently.
No, I think that's a great point. And I think now that the legal risks is gone, one thing that remains is still the career risk. And I think you hinted on that with the not to take risk with such a small position. It's still very asymmetric in their mind of why would we take such a small position and stick our neck out when it could have a lot of blowback. But that just takes time. There's some of these things that there's no way to rush it. It just has to continue to permeate the space. People have to get educated about it. And once more people do it, though, then that career risk will go away as well.
Right. Perhaps you want to just guide us roughly through these numbers, because I think they are very interesting when it comes to this asymmetry and when it comes to risk return.
Yes, there's a lot going on with this chart, but it's trying to answer the risk versus return question. And so getting back to that comment of volatility is no reason not to invest. Instead, as a sophisticated investor, you should be asking, what kind of return am I getting for taking on this risk? And so I don't think the time frame is shown here. That maybe got missed, but I'll note it verbally here. This is over the past 8 years. And you might say, why 8 years? I try to be really intellectually honest in all of our work. And I think PlanB will agree, if you're going to look at Bitcoin, you've got to have a full cycle of 4 years. So you got to look at multiples of 4, because if you do anything more or less, you're going to start picking tops and bottoms, and you could make these numbers really skew one way or the other. So if you do the past 8 years, you get a little bigger data set. If you only do the past 4 years, Bitcoin's performance would not look quite as good as this. So just being upfront about that, but it is what it is. And so over the past 8 years, total return of Bitcoin and the annual return of 78% far outpaces everything. But of course, what sticks out is that big red box next to it, which is all its risk also sticks out far above everything else. And so you've got a standard deviation of 81%. PlanB alluded to this with a vol of 80 plus, and then a max drawdown, so you have to stomach at least 75, 80 plus % as well. But you put those two together, and your Sharpe ratio, as you know, is your return over the risk-free rate divided by your risk, your standard deviation. It's the best Sharpe ratio out of all these assets. And then the Sortino ratio, I think, is very interesting because it takes the Sharpe ratio and it only looks at downside deviation, standard deviation. So in other words, investors don't care if something is volatile when it's going up. When Bitcoin's ripping high and going to the moon, nobody cares about that volatility. They only care about the downside. So I think the Sortino is instructed to look at as well. But I'd be curious if PlanB has any comments more on the quant or side of this as well, of how he views Bitcoin versus other major asset classes.
Yeah, I could talk for a whole day about this chart. I probably should do that offsite, but I love this chart so much, and I think there's a lot of misunderstanding, even among institutional investors about it. By the way, I think the institutional investor class is a very diverse bunch. Because, for example, you, Chris, work for Fidelity, which is mainly a fund business, right? Assets under management and a very small own balance sheet and own capital to manage. Whereas I was working for banks and investment insurance companies that had an own balance sheet, and it was all about asset liability management and capital management. And I guess that makes a difference about how you look at this chart, for example. And the high volatility would be very scary for a bank that has short duration savings products as a liability, and then is looking for some, not too much risk assets to hedge against that liability. Maybe for a pension fund that's different because they have a much longer horizon. So, for example, that 4-year horizon that you mentioned, or 8-year or 12-year even, it would be a better fit. But even then, I could not sell this exact table to my colleagues in the institution where I used to work. And they are all very schooled in mathematics, statistics, in the risk-adjusted returns. But I couldn't sell this table. Well, these are the facts, despite all the risk that you mentioned in the chart before. This table speaks loudly and says you should have Bitcoin in your asset mix. Either way, I mean, this is the best performing asset, no matter how you look. If you look at it from a Sharpe ratio perspective or Sortino ratio perspective, or I prefer the Kalmar ratio perspective. That is then you divide it by the maximum drawdown, which is even more punishing the risk. And I think there is the fundamental flaw in the asset liability committees, and it's very nerdy maybe, but if you look at a Kalmar ratio, so a drawdown definition of risk versus the return, then Bitcoin outperforms the classical 60-40 stocks bond portfolio. It outperforms that standard portfolio that every bank and every pension funds in pension insurance has, and so it would actually argue for an only, in my view, and that's more or less a statement. I'm very interested to hear your feedback. That would actually argue for a Bitcoin and cash only position for pension related purposes, because that outperforms on a risk adjusted return. If you look at drawdown and Kalmar ratio, it outperforms the classic 60-40 portfolio.
Yeah, I think that's very interesting. It's hard to think of it that way. It's not intuitive, but I think you're right. If you have something that's so jet fuel charged, whatever you want to call it, you just pad that with a massive cash balance sheet to maybe overcome some of that risk that some of these companies have to face.
Well, I mean, I have to bite my tongue to not say this at this point of time, because we actually have a solution here at Incrementum, because we do combine Bitcoin digital gold with physical gold, and that was actually one of our learnings when we initially pitched Bitcoin and saw the volatility problem. And actually, you can outperform on a risk-adjusted basis Bitcoin even when you combine Bitcoin with gold and rebalance it. So we were able to do that. I mean, not by a huge margin, but it was possible. I think it will be possible, providing gold continues to rise also and contribute to returns. But I think that's the way we think. We think that this bunch of non-inflatable assets could become like a supplement for your 60-40 portfolio, financial assets and non-inflatable assets, hard money assets in combination. That's, I think, where how we think about constructing a really broad portfolio. But sorry for that little bit of shameless self-promotion.
It actually brings up a question I have for both of you, Mark and PlanB, something I'm thinking about. Number one, a comment that relates to this is nobody's talking about how red the bond boxes are in this chart. One of the worst. This is 6. I had to triple check those numbers. 6% over 8 years total return, including the dividends, is just absolutely abysmal. And of course, I think, Mark, you and I are probably more on the same page of worrying about these structural deficits and government debt that's been accumulating. So that, and then my question is, how do you think about Bitcoin and gold in a portfolio? I recently put out a tweet talking about my colleague, I'll steal his phrase, Jurrien Timmer here at Fidelity. He's got a great line that says he views gold and Bitcoin different players, but on the same team. And so you see sometimes gold and Bitcoin passing passing the performance back and forth with each other. So for an example, 2020, gold moved up 35%, which is a massive move for gold. Bitcoin moved up later, 20%, and then actually went back down, and it was just flat compared to gold's 35% move. And then later, Bitcoin outperformed gold. So I'm curious how you think of that from a portfolio perspective, or how that works in your mind, both of you.
Want to go first, PlanB?
Yeah, I think it makes sense. They're certainly on the same team. They're on the team that cannot be printed, of assets that cannot be printed by the government or by a company. You can't increase the production of gold very much more than it is now, because you need massive capital investment, and for Bitcoin it's impossible. So every time there's a need for an asset that's like a crisis asset, or an asset that absorbs the inflation that's caused by the money printing of governments and central banks, then gold, of course, and Bitcoin play the same role, and it absolutely makes sense. And Mark, you said that a minute ago. That's what I like about the incrementum fund. As you see the gold and digital gold, Bitcoin interplay together with the volatility, because that's you guys use the volatility as well, and I sometimes say that volatility is an asset on its own. it's an asset. That is a very interesting combination to look at, and not just for commodity funds or private prop traders or hedge funds, but also for banks and pension funds. And it really amazes me that it's not happening at the moment. And I expect that actually I know, because I know that's what was the discussion at my institution. I know that central banks and the regulators play a big role in that, because as long as central banks and regulators punish institutions for having Bitcoin on their balance sheets, and punish, I mean applying massive capital charges, so you have to hold a lot of capital against that asset. As long as they keep doing that, they won't do it. They won't go against. So don't fight the Fed. Basically, is what's at play here, I guess.
Right. Yeah. Well, what should I add? We are convinced that the combination it makes sense, and I think wrote 2019 in our Gold We Trust report, Bitcoin and gold are friends, not foes. And we've been writing about Bitcoin since 2015, and not all of the gold enthusiasts were extremely happy about our position, and I end up to arguing with Bitcoiners about gold and with gold people about Bitcoin. But I think I'm convinced that both assets actually have their merit. And I mean, the argument from the Bitcoin side that gold is going to be demonetized. I mean, first of all, it has been demonetized already 53 years ago, but it still has a monetary use case, obviously. And I always counter argue that argument, pointing out that central banks in practice increase their gold holdings. It's just a fact, like it or not. They could start increasing their Bitcoin holdings, and perhaps we will see this at some point. We can talk about nation state adoption, perhaps in the remaining minutes of our call. But for the time being, and for the showdown, the geopolitical showdown, as we coined it, which is clearly happening currently, gold is increasing monetary value and properties from central banks at least, but also from private investors. So perhaps in a distant future, it could become more replaced by Bitcoin. I wouldn't rule that out, but for the time being, I see both roles increasing, and therefore we think the combination makes sense due to the different risk-return properties. Perhaps we do want to segue to the nation-state adoption at this point. I don't know if you have specific views, but I was quite surprised how explicitly at that point two presidential candidates came out at the Bitcoin conference. It is being talked about that the US could potentially declare Bitcoin as strategic reserves. At least Donald Trump said that at the Bitcoin conference, and RFK Jr. Also said that very explicitly. Obviously, the race is ongoing, but for me, these kind of statements are very, very important, because this, even only a few years ago, was pretty unthinkable that this could happen so fast to me. Do you have any thoughts on that and potential implications if that really should materialize?
I would first agree with you that the main takeaway here is that we're talking about it, and this is even happening. There were people on CNBC, you can go back to interviews, saying they think Bitcoin will be a major election issue in the year 2030 or something like that. And even that was laughed at the time, and here we are. So these long-term trends tend to happen faster. What's the old saying, like we overestimate what can happen in the short term and underestimate what can happen in the long term. And so I was not entirely surprised to see this. And in terms of, I don't have a personal opinion other than we did write back in one of our year in reviews and previews where we try to make a few, not predictions, but we look at the year ahead. Way back in 2022, the beginning of 2022, we said we've seen a country adopt it. Now the only thing left is to either see more countries adopt it or maybe even a central bank adopt it. And so the last thing we have not seen yet is a central bank adopt it as a reserve asset on its balance sheet. And then, of course, the country adoption has not gone much further. But I'm a big economics nerd, and I'm sure that's a big surprise, but love studying game theory. And I look at it through a game theory lens. If other countries start adopting it, countries don't have an option to just not have an opinion. They're going to have to make a decision whether or not they're going to play the game or not. And then you start to play out the different scenarios in those little squares of game theory, and you see where the incentives lie of how these countries might need to adopt it just as a defensive mechanism, even if they don't believe in the technology or it as an asset class. It just becomes imperative that they at least look at it and start to think about it defensively.
Yeah, I agree with that completely. And as kind of as a joke, I tweeted earlier this year that Trump had to do only one thing to win the election, that is to embrace Bitcoin, because that would gain him 50 million voters. So I was kind of surprised to see him do that, but I actually think it's a smart move. But for him to do that, he must first win the election, and the entire democratic process has to work, and then he has to probably change Gensler and Elizabeth Warren and a whole bunch of other people, because 50% of America doesn't like Bitcoin, and certainly not the government playing a role in it. So the fact that, for example, El Salvador was the first to have a nation state to do Bitcoin, of course, has everything to do with the fact there's the democratic process, or the government process is different. There's a leader who has a lot more power than in a usual European or American state. So I would expect that for example, countries with a more dictatorial regime, I'm thinking Russia, but maybe the Middle East as well, it's much easier to implement the Bitcoin strategy, and we might see some surprises from that part of the world which is also a very rich part of the world. It would certainly do more than El Salvador at the moment.
Right. Well, I mean, what was surprising to me, we've in the Bitcoin community, we all are talking about game theory for a very long time, and it is happening, and has been playing out at different levels, right? But when it comes to nation state adoption, when we saw El Salvador adopting Bitcoin a few years ago, for me, like the game which potentially would be playing out, coming kind of from the periphery, right? If you think about the dollar-centric global monetary system which we currently have, that more like very small states perhaps start using Bitcoin, but that this potentially, I mean, it hasn't happened yet, but potentially could be leapfrogged and go directly into the center kind of the global monetary system. That was the big surprise to me, at least. As I said, we only have heard some words from potential future political leaders. So this is still now. It's still fiction, and it hasn't happened yet. But this potential of leapfrogging all this domino effect, which I imagined, and I think a lot of people imagined, potentially coming from the periphery directly to the center. I mean, what that would cause, I think, in terms of knock-on effect, that would be so huge in my imagination. So I don't know if you have thought about any kind of price ranges which could be the implication of, obviously not talking about the Bitcoin standard, but just let's perhaps think about the US really institutionalizing a strategic reserve of Bitcoin, which in my view would make it officially some kind of a monetary asset. I mean, this wouldn't give it a huge premium in the moment that this is realized, and how big could this premium be? Do you dare any predictions, Chris, or PlanB?
Chris, you go first.
I don't have any predictions, but one thing I think in terms of mentally looking at this as a model, Mark, correct me if I'm wrong, I think in one of your charts, probably the In Gold We Trust one, is some chart of showing when the world was on a gold standard, what percent gold was of all financial assets. And so right. I think if you take something like that as the ultimate or near ultimate scenario of Bitcoin becoming a global reserve asset that countries and central banks hold and use, and then stuff gets built on top of it, you can start to do some back of the envelope math, just like we talked about with the total addressable market. Say X trillion dollars of assets out there, Bitcoin's becomes X percent, similar to what gold did in the past, and then you could arrive at a price that way. Very crude, but it's at least somewhere to start.
Yeah,
I would go that way too. I mean, that brings you to huge numbers, obviously, huge numbers.
Yeah, and I think what also plays a role is that, and that would be the next step even after nation-state adoption, it's that we use the dollar as a unit of account for everything now. But there might come a day that we switch back to gold or even to Bitcoin, or at least ditch the dollar as the reserve currency, or at least the unit of account. Because even currently, at the current levels of inflation, looking at that dark blue line in Chris's table for the yield of bonds, that is really bad. That's negative risk-adjusted returns. That's yeah. So that dark red line with negative Sharpe ratios and negative Sortino ratios and even worse Kalmar ratios. That's U.S. investment grade bonds. That basically is the U.S. dollar. So I think in the current context with BRICS countries gaining power and the US losing power very, very rapidly, we might one day, maybe in the not so far future, be not using the dollar anymore as a unit of account, because it doesn't make sense. I guess there's a case to be made that it already makes more sense to use gold as a unit of account, because it's more stable in terms of purchasing power. So that the whole context of BRICS countries doing more trade in everything else but the dollar, and is very interesting and has the potential to have a black swan event, but in the positive way for Bitcoin, and of course the Bitcoin price in dollars would jump, and the same for gold, but it would have more to do with the dollar than with Bitcoin, obviously.
Well, thanks for that. I mean, we could go on, I think, for quite a while still, but I think we're going to finish up soon. I think we heard some compelling arguments when it comes to analyzing the pattern of the previous halving cycles, that we could be facing a very interesting time in the next 12 to 14 months. And we, I think, also covered quite a few potential fundamental reasons for potential price gains in Bitcoin. Gentlemen, any final comments from your side still? Did we forget something, or do you want to add something? Where can we find you? Where can we find your research? Perhaps you want to also tell our audience that too.
Sure. You can find all of the research that myself and our team does at fidelitydigitalassets.com. We put almost all of our research up for free on our website, and you can learn more about us there. And then I'm on X, formerly Twitter, at Chris J. Kuiper.
Yeah, so
Thanks, Chris.
So I'm on X and YouTube too. Just look for PlanB, you'll find me, or look at the website planbtc.com. It directly leads you to the social media accounts. Maybe one more question for Chris and Mark. One question that bothers me is the volatility in the future. What do you guys think? Will it stay the same? Will it decrease or increase? I think a lot of depends. That chart. Will that decline continue, or will Bitcoin be high volatile for the next 10 years?
As you like. I can go first, Chris.
Yeah, go ahead.
Well, my opinion is a little bit different than the opinion which I hear most oftentimes from within the Bitcoin community. I mean, what we see here is a little bit of a downward sloping line, so volatility has been falling. These are only the last 4 years. If one takes this chart back further, the decline was more significantly. Obviously, in the first years, Bitcoin was more volatile than it is today. But oftentimes, I think it is expected that this volatility should basically decline proportionately to the increase of its market size. And I have argued with a lot of people that I don't think that this is a given. I mean, we could see some further declines, but in terms of actually max drawdowns, the declines weren't significant actually, because I mean the last max drawdown, as we can see here, is 77, something like that, versus 83, and that was with a much higher magnitude of market cap, so not so significant decline. And what I learned from gold, or what distinguishes gold relative to Bitcoin, I mean, one of the properties obviously is its physicality, right? And I think the advantage which Bitcoin has over gold in terms of non-physicality, which makes it much more are rapid to transfer and verifiable and so on. That is great, but the physicality does have an advantage in terms of dampening the volatility and also the dual use as an industrial metal. That has a disadvantage, one could argue, as a not quite perfect money, since it is used industrial for industrial purposes. But it has an advantage when it comes to dampening the volatility. So I think Bitcoin's volatility will never approach gold's volatility due to the fact that it has no physicality and due to the fact that it has no industrial use case, and even also a secondary store of value use case when it comes to jewelry. So just very briefly, what one can see on the demand side of gold, biggest demand factor traditionally always was India. Now it's China and India, but these are very counter-cyclically acting market participants. So when the market price drops, Indians buy much more, and when it rises, Indians buy less. Right, so it's a very predictable outcome. They always, basically, I see it that way. They always buy as much as they can purchase relative to their FX rate, to the GDP, and to the gold price. And on the supply side, you've got scrap gold, which is, you are incentivized to find scrap gold and supply it to the market, which also dampens volatility. So the monetary demand, which goes in and out into gold and Bitcoin for that matter, it will always be dampened more, I think, much more significantly higher than Bitcoin. So that's the one thing, and the final point with ETFs. I think with the ETFs, we've got even the potential that max drawdowns could even increase again on the Bitcoin side when we see some kind of a liquidation event, when we see some kind of problems on the macro side, provided that the institutional adoption has already increased, and if we're talking about perhaps 10% or 20% of all Bitcoin being held by institutions in the future at some point, and you have some kind of a liquidity event, I think the potential for a high max drawdown, potentially even higher than the last one, is there. So I do not expect falling volatility.
Very interesting.
Yeah, I agree with a lot of that. What you just said about the gold market, the stock versus the flow, scrap metal, jewelry, all of it aligns very well with the book I just read from a professor I studied under at George Mason University, Dr. Larry White. He wrote a book called Better Money, Gold, Fiat, or Bitcoin. And he goes through each of these as a money, gold, fiat, and Bitcoin. And it's just a very objective way of looking at it from an economic perspective. And he uses these kind of ingenious supply and demand graphs for gold especially. He has one supply and demand graph for gold as money, people wanting to hold it and use it as money. And then the supply and demand of gold as gold, the asset, the stock, the flow of it, the stock and flow. So, and then those two are linked. And so I agree with you, Mark, that because you have those markets, you have these counter-cyclical and dampening things. If the price of gold shoots up, we find better ways to mine it. People start turning in their jewelry that they don't want or need anymore. And so you have those. And Bitcoin, you don't have those, right? It's completely inelastic. It is pure monetary good, pure monetary premium. And so you get these massive swings with that because any change in demand has to be reflected in change in price. You cannot have supply help you out and dampen those moves in changes in demand. Now, Dr. Larry White in the book, and I actually had a conversation with him on this, he's not against Bitcoin, but he believes Bitcoin will never become money precisely because of this reason. It's much too volatile. It has no counter-cyclical effects. And I would actually disagree with that in that I think the volatility can go down as it gets bigger. It doesn't necessarily have to. Just because something's a big asset doesn't mean volatility has to go down. We see big Magnificent Seven stocks, for example, make huge moves. But that does help. And then on the financialization part, that's an interesting question too, that I don't know exactly where I'd land, because I hear you in that some products could create more volatility. But historically, the introduction of derivatives, futures, options actually dampen volatility, because you've got players then that want to use volatility as an asset class. They're the ones that are going to participate. And so you see this with commodity markets. Commodities used to not be an investable asset class, and then they did in the 2000s, and all these products came about, and I think they became much more investable, a lot less volatile because of that. But I'm not sure yet. Haven't done quite enough work, so we'll continue to see how this plays out.
I think these are good arguments, but I just want to point out something. I'm purely talking about as long as we are in a fiat currency system, so where we basically have gold and Bitcoin at the sideline as non-inflatable assets, as store of value. But I think these two viewpoints can be reconciled, actually, because I disagree with Larry White, because I think one of his major arguments that Bitcoin cannot become money, at least historically he said that, was that he can't imagine that this kind of network effect actually happens. But I think we've got a lot of evidence that Bitcoin already has gained critical mass. I think these views can be reconciled, because I think that's mentally quite difficult. But going back to gold had zero volatility till 53 years ago. Mm-hmm. So gold actually was the riskiest asset, and it has, due to government power, basically, the government was able to ban it into the universe of risky assets, right? Because the government can decide what the unit of account is, right? And I think it is more likely that such a I don't think we're gonna land in some kind of a Bitcoin standard by ever decreasing volatility. I think it's more likely that if we hopefully land in such a world, then that it will become through some kind of a reverse jump, that somebody by decree says, now this is the new unit of account, and by definition, then the volatility, at least in this currency, is zero, right? So that is possible. That is possible that it goes to zero in this kind of scenario.
Yeah, excellent points.
Okay, PlanB, anything to add, or shall we call it a day?
No. I agree that the volatility won't go away. I think it's the one of the final assets that volatility can live in, is allowed to live in, because all the other assets are controlled by circuit breakers or weekends, or at least somebody is managing the price. And with Bitcoin, nobody cares. So the volatility, this is the only asset where the volatility can really ferociously be volatility, and that's a good thing. I have one, if I may, final request for Chris, and that is my beloved table, the one we talked about with all the risk adjusted returns. Could you? It would be so interesting to add one row and one column, and the one column, of course, would be the Kalmar ratio, where we use the drawdown as a risk factor.
Yeah, I think that's a great idea. It's funny, I presented this most recently at the Bitcoin conference, and I actually got some feedback from people in the financial world who said, I'd never actually heard of the Sortino ratio. So things that I take for granted are out there, and I would assume the Kalmar ratio is probably similar for a lot of people.
Well, and that's exactly, I have the same experience, and that's exactly why I said there's a big misunderstanding there, even in institutions, because you would think that they know it, but it's more in the exotic hedge fund world that they know all about Sharpe ratio, Sortino ratio, Kalmar ratio, and in most institutional investment companies they don't. Certainly not at the at the higher levels. But I think using that column would make a lot clearer. And as a row, I would add the 60-40 portfolio, because it's the benchmark, and then you would very clearly see that Bitcoin even outperforms that.
Sure. Yep.
And coming from you, that would make a hell of a lot more impact than coming from some anonymous Bitcoin account.
Yeah, someone who has millions of followers, though.
Yeah, well, yeah, but yeah.
No, very good
Brilliant,
suggestions. I'll definitely look into that and add those.
Thank you.
Okay, well, with that, I want to thank you so much. I think that was really interesting, and we will upload everything. Yeah, I hope to perhaps do this again, and thanks for your time, and thanks for your interest to the viewers.
Thank you, Mark.
Take care, everyone.
Thank you very much.